Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for August 29th, 2015. The market is in bear volatile conditions. On an annual basis with weekly RSI 14, we're at 40 out of 100. 30 is the threshold before it gets to oversold, which is always an interesting condition. On a 10-day basis, using the 10-day NDX, we're at 60 out of 100, so slightly above the midpoint. Looking at the market mosaic, price relative to the 200 is minus 3.41%. That's what puts us into bearish conditions. The slope of the 50 is very negative at minus 0.67. It's red bearish. ADX 14 is 33.7, strongly trending downward market. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. The current reading is at 0.666, so we are in certainly into risk off. We take that score of 0.666 and compare it to the last 5,000 trading days, find the average and the standard deviation of that time period, and we compute the risk Z. It's at minus 4.06. That's 4 standard deviations below the long-term historical average, which tells you something about just how volatile this market has been. It's historically volatile. But you notice the downward slope in this histogram of that of the last 90 days is starting to slow down. When this gets us a couple days up, then that starts becoming prime time for long side trades at a deep discount, deep value. It's also a signal for tradability on the long side and volatility. But as it stands right now, what we're looking for is symbol VXX for one-day day trades, XIV also for one-day day trades, because rebounds under these conditions can be very interesting as well, but certainly not swing trading yet. Looking at blended monthly rebalancing, all of the stops were hit in ETF2. I should say in blended monthly rebalancing, these were the holdings at the start of the month, and these are the winners as of close of business Friday, so there will be some rebalancing due in early next week. I don't expect much change in those, and I think even among the winners, probably only treasuries are going to be above their 4-month moving average, so there's going to be a lot of cash being held for the next month in blended monthly rebalancing. ETF2, all the stops were hit with the exception of PFF. The model portfolio is at 10% exposed in that model, and the stop positions certainly did their work in protecting against capital loss. This is the selected look at blended monthly rebalancing portfolios. You can see again, only treasuries and the short-term bonds are above their 4-month moving averages, the only ones on buy signals. You can see just how much rebound there was in the 1-week performances, and so there are some opportunities for very short-term trading and intraday trading that come out of this kind of analysis, but certainly these are very tactical and short time frames that favor only the agile, disciplined trader. Notice the 10% bounce in Australia, for example, and 6, 7, and 8% in the emerging markets, Asia less Japan and Latin America. So those are one-day, tactical opportunities. So let the trader beware. In the ETF Max, again, this being dominated here by volatility and short-term income-producing ETFs. Even among the top 50 here in ETF Max, quite a few are on cash signals, so you can see just how volatile this market has been. This one shows the S&P 500 currently racked and stacked by the blended performance. And again, what I want you to notice is just how volatile these symbols can be that are at the extremes of either outperformance or underperformance. And so Netflix, which has been on our short list for trading, had a 21% week, 51% week in Cameron. So we're going to take a look at Netflix, Amazon, and Under Armour, Starbucks. And what I'm looking for here are those. I would call anything that's green in week one as a relative strength leader, where people are trying to find long-term momentum leaders who are at a deep discount, so they think there's more left in them. So when the volatility settles down, I would still expect these things that are standing out now to be exceptional going forward. And Cablevision down here in position 42 is like that as well, 11%, 10%. Facebook also, we got to add that. These are symbols that I'm going to be framing tonight with members for the week ahead. And I like to show this one again. This is evidence that supports the saying that from extreme conditions come extreme results. This was the order of merit from last week in terms of blended monthly rebalancing lens, and then the weekly performances, but not resorted. So you can see things like Expedia dropped all the way to the 26th position. So this was the top 20 or so from last week. And what I want you to notice is all the green and the red. These are all things that were exceptional outperformers either on the upside or the downside. And then all these in the yellow are ones where they were slow to recover. So this is a case where something like Altera and Hartford and Sealed Air, these had been relative strength leaders, but their rebound during the week was decidedly underwhelming compared to the rest of the database. And so what I like to do is find out the ones that don't have deep conviction. I take Netflix and Under Armour to be the case where they have been awesome on 3 months and 6 months, as you can see. And so was Altera. It wasn't bad. It's in the green. But after the volatility, there was not a huge rush to come back in and start buying all of these that are in the yellow. But the ones that are in the green is one where there's still considerable amount of buy-on-dip opportunity enthusiasm, whereas GameStop, for example, didn't rebound at all. And so that's a case where it drops all the way down to slot number 52, because given the opportunity for people to step in and buy it at a deep discount, in fact, they didn't. And so it actually lost another % at the same time that Netflix and Under Armour were rebounding. So I like to see these symbols as being psychologically attractive to short-term traders who are still looking to get in on something exceptional when the price has pulled back. So that's why things like Netflix, Under Armour, Amazon, Cablevision are on my short list. You can see here in the market health check, the vertical blue lines are 10, 20, and 30 days worth of pullback. This is 30, or look back, this is 30 and 60. I'm treating fair value as the midpoint of the dragon, so I see that to be right around 202. There was a nice bounce here from 183 all the way back to almost 200. So that's a 9% bounce on the market. And that gives you the size of the move in Netflix was twice the size of the rebound in the market, which is what still makes it attractive. You can see the sine wave, which is the slope of the 30-period regression line, the moving regression line. That slope right now is at a negative minus 0.52. Anything beyond minus 0.22 historically is extremely steep down. So that's, again, a historic sell-off over those days, even with that nice rebound. And you can see that is starting to turn already at the bottom as it's approaching the 6 o'clock position. This had been as high as the green dot up here about 0.1. These blue dots are where that slope crossed the zero lining and went negative or positive, and this sort of shows you the dimensions of that. The red line, thick red line in the shaded area is the 200 period moving average. You can see we're deeply below that. Well, not deeply, it's 3.5%, but we're certainly underwater, or as I like to feel, like in the lava, which is why I color it red. And that reminds me that we are in those bearish conditions, which is why I like to show that in such a visual array on my chart. We get back into the river above 200, and then it's slightly less pessimistic. Above the Bollinger Band mean is where I'm really ready to go. I lose my directional bias. I will have a downward directional bias until we get above the Bollinger Band mean here in the middle of the river at about 207. Until that time, my time horizon is very short tactical trading and emphasizing the downside whenever that appears. I'm reminded we're in bear volatile conditions. You can see that the percent price oscillator, the jaws are still open to the downside, but this rebound of the last 4 or 5 days has started to close that considerably. So there are some tactical opportunities on the short side, which is why I'm willing to tolerate targets like Netflix, Cablevision, Under Armour, and so forth. In ETF 2, everything in the world market model is on cash, which keeps us at a 0% invested. That was a very nice capital preservation warning that this model gives us to give us insights into the health of the world market model. The S&P is still better than EFA, so 64 is better than 59, so it's the U.S. over the globals. Inside the U.S., it's technology, then large caps, then small caps, then mid caps. The two strongest sectors being Japan at 67 and technology at 67. Two weakest sectors remain emerging markets and Latin America. Inside the S&P sector spiders, it's only consumer discretionary XLY that is showing strength. Although healthcare, it looks to me, is an opportunity to get back at a value play or at a value price into what had been the strongest sector. So I'll be stalking that opportunity. In the world market model itself, everything in the U.S. is above average. Everything Asia, less Japan, is less than the database average or extremely so. Singapore and Hong Kong look to me to be of interest. Those are mature economies. They're small enough to allow some tactical trading, and I'll be stalking them for swing positions as we go forward. Equities, real estate, bonds, and treasuries, even gold is now above average. First time we can say that for a while. Silver, there may be some follow-through still available in there. Oil still getting punished, but I think it may have turned the corner. The energy complex globally is weak, along with materials, and seeing a recovery in some of the currencies, which is a shift away from that strong dollar tactically. Among the ETF 2 top 30s, all these that are green and white is a reflection of the changing of the guard. These are all those bonds and short-term interest generating symbols. S&P Biotech is the first leader that we find across there, along with the Internet Index, of course, too. But the biotechs are really the only thing that remain green and green. And so this can be an anomaly that lasts for the next couple weeks while the equities start playing catch up again. So again, this just reinforces that this is tactically short-term opportunities, and you're really having to pick winners if you're going to try to start doing swing trading. Not my recommended tactic. Inside the Dow, Nike remains up at the top. McDonald's rejoined them. Otherwise, Goldman Sachs, Visa, Home Depot is now green and green. It has moved its way up from the red all the way up into the green, and so we've been able to benefit from Home Depot. So I'm going to keep that on my list. I'm going to add Brazil. Yeah. let's see, Nike for follow through. McDonald's, I'll be studying. Intel, United Tech, real weak in the tech sector, which had been strong. So that's red and yellow, meaning they have lost a lot lately. IBM and Cisco on the way down, as is Apple. So those big five there in technology all have gotten really smacked down, which, as a contrarian, now suggests to me that Apple's got to be on my short list, and I'm going to look at XLK and QQQ anyway, just as a chance to get back into technology at a position of advantage. I like that McDonald's, Home Depot, Visa, and Nike are all on a buy signal. Those are the only four in the Dow that are above their 4-month moving average. That tells you where the residual strength is. ETF liquidity. Notice the ATR percentage of VIX, 8.5% a day. It's been swinging, and the volatility in gold miners almost 5.5%. Oil and gas exploration over 4%. So some significant volatility, favoring again the short-term intraday trader. Look into the daily report. No signals in channeling and overreaction. We get triple screens in gold, a 55W, and American Express. Lots of goodies in the auto framer that test out better than 2-to-1. You just notice the ATR percentage almost looking like it has peaked and started to roll over. So that now sets up a really nice swing trade here in the near future for XIV once we get a turning point. So I'll be looking to rebuild my positions there. I still have an initial position in that is hedged. In the Dow tactical, again, you can see everything firing on the auto framer, not surprising given the sharp sell-off. Weakness on Friday in Pfizer, Walmart, Johnson & Johnson, but strength in Chevron and Intel. Same thing in the ETF 30s. All the auto framer numbers testing out well. And then the sell-off here in XIV, you can see how that has shifted its percentages, looking at the last 1 day, 10 day, 1 month, and 3 months, and correspondingly in the VIX. But again, I think we're closer to the end than the beginning of that in terms of switching the volatility trend back to decaying volatility. I'm looking for that to start rebuilding my long-term position. Many to choose from here in the auto framer and in the regression line fractal framework. In the red, the bottom shelf, the ones that are the most ATRs above their own RL 270. So these are going to be your relative strength leaders. Again, no surprise. Nike, Johnson & Johnson, McDonald's, and then the big losers remaining. These are the ones that are below their RL 270. DuPont, United Tech, Walmart, 3M, and Disney. These are the daily squeezes, the ones that where their range on Friday was 0.7 or less of their average range of the last 30 days. You can see how range compressed Friday was. These are in the 0.3s and 0.4s of their range. And then the posture for potential gains, where we take the range stat and divide it by the level of risk that we're looking for, gives us some favorable one-day pops. And so there's lots of good one-day pops available in here, which is why my time horizon has shortened up so much. Recovery in the last 4 or 5 days from the spike sell-off. You see the slope of the RL30 has started to, the speed has started to roll, of decline has started to roll over, and looking for it to improve. We really want to see this, when this crosses its own 10-period moving average at a distance more than 1 SD from the long-term average, is when we want to really shift our orientation back towards potential gains. And the percent stretch relative to the 200-day moving average looks like almost 5 standard deviation pull away from the long-term average here. And and that nice rebound of this past week. In a historical context, we are still below average. This is one of the worst 10 slopes of the last 10 years. Again, you can see us starting to catch up to the 10-period moving average. When this crossover occurs at a distance more than 1 SD away from that average, there's always been a nice follow-through. And that's everything I want to cover during this weekend's report. Again, this is really a tactical trader's opportunity here while the fish are running. Too soon to start rebuilding swing positions, in my opinion, unless you're doing it with markets money. And again, my focus is going to be on the volatility pair. I'm going to favor the previous relative strength leaders that have shown evidence of coming back sharply, and that's going to be things that I've highlighted here: Netflix, Amazon, United, or Under Armour, Starbucks, Cablevision, Facebook, Home Depot. So that's everything from Tortoise Capital for this weekend. Keep your risk measured and your powder dry, and we'll see you in the chat room.